Thanks for joining us for this talk. I'll take 2 to 3 minutes to introduce our speaker, Andrew, and then we jump right into his presentation. So a quick introduction. Andrew is a partner at Climate Finance Advisors, where he focuses on the intersection of international development, public policy, climate finance, and sustainable investing. He has advised a wide range of important actors in the sphere of climate finance, including the C40 Cities Climate Leadership Group, the United Nations Environmental Programme Finance Initiative, the UNEP-FI, the Global Commission on Adaptation, and ClimateWorks Foundation. And some of the works Andrew has recently completed would include strategies on sustainable cooling, an assessment on climate-related insurance products, national assessment for promoting investment in resilience, and supporting financial institutions to mainstream climate risk considerations in the strategy and operations. So a wide range of experience and expertise on climate finance. Last but not least, Andrew is also a fellow Princeton alumnus. He graduated from the Master in Public Affairs program SBA in 2009. So welcome back to Princeton virtually. We are really happy to have you today, and the floor is yours, Andrew.
Thanks so much, Chang-Woon and Pallavi. Good afternoon, everyone. Real pleasure to be here. As Chang-Woon said, virtually back at Princeton. It's always a delight to re-engage with the community of students, faculty, and other community members. Let me just take a moment here to share my screen. Okay. Can everyone see the slides? Are they sharing properly?
Yes, perfect.
All right, wonderful. As Chang-Woon said, I'm, in addition to being a Princeton alumnus, I am a partner with Climate Finance Advisors, which is a boutique consultancy. And I'll tell you a little bit more about that in a moment. In our work, we focus a lot on helping to mobilize financial resources for climate solutions. And these days, as you can imagine, there's a lot of intersection between finance for climate change issues and finance for the green recovery to COVID-19. And we've been doing some work on this subject. And so I proposed this topic for today's discussion: financing the green and just recovery, municipal investment in climate solutions in the age of COVID-19. Cities are a particularly interesting locus of investment and of policymaking because the decisions and dollars invested that actually bend the emissions curve and help build resilience typically are happening at the local and regional level. And it's really important to make sure that solutions are being deployed at that level to meet the world's climate challenges and the challenges of local communities as well. So let me, without any further ado, start rolling through the slides here. A couple words about Climate Finance Advisors before we start. We are a Benefit LLC, a mission-driven, women-owned company, recently certified as a B Corporation. We focus on designing and supporting financial solutions that mobilize private investment and also mobilize public investment and redirect resources that may not be climate focused in a manner that helps ensure they have a positive climate impact. So we have a number of different practice areas. We have climate smart investing. We have climate smart policy, both of which sort of fall under our climate strategies bucket. We do blended finance. We mainstream climate considerations into financial institutions, and we do a lot of work on climate risk and resilience. And I should add, we're a small firm based out of Washington, D.C., with a virtual team, mostly up and down the East Coast, and I'm based in New York City. So for today's discussion, I am going to walk through a couple of different studies that have focused on this issue of cities' green investment for the recovery to COVID-19 at the city level, in particular drawing on some experience that I've had personally being involved in this work over the past 6 months or so. One of these, so two of these are published studies. One is an unpublished client assignment that we've had. Two of them are for C40 Cities Climate Leadership Group, which is a not-for-profit based in the US and the UK that brings together cities the world over to address policy-related climate challenges. The black ringed cover you see on the left is the cover of the report that we published in December for C40 Cities on financing the green and just recovery. So I'll start with that, and then we'll come to the study on the right, which in some respects is a companion study done by the Cities Climate Finance Leadership Alliance, also looking at urban climate finance with a particular focus on multilateral and international development institutions. And our third study also is focused on multilateral development banks or MDBs. So what I'll do is give a little bit of an introduction into this topic, and then delve into these three different studies to, I guess, sort of take a mosaic approach to present a few different recent examinations of this topic. So starting with the C40 Cities paper, we'll begin with some background and context, and then I'll walk you through the research approach and our methodology for coming up with financing options that would be relevant, accessible, and high impact for cities. We'll also talk a little bit about financing challenges that cities have for their climate agendas in general, and how those have been exacerbated in the era of the pandemic, and also what some of the key enablers are of that financing, and what our conclusions were emerging from this exercise. So for starters, it's important to note that cities' budgets can be funded from a variety of different sources. But unlike nation states or even states and provinces, they are often acutely sensitive to local economic conditions in terms of their inflows into local government. This particular slide, or rather the graphic on the right, is focused specifically on cities in the United States. Taken from a New York Times article that published the beginning of last summer. But it illustrates, if this is the diversity of funding sources, even amongst cities just in the US, there's an even broader diversity of, what these bands look like for cities across the world. You can see there's federal aid, there's state aid, property tax, sales tax, charges and fees, so that can be excise taxes, it can be fees for utility services and things like that, as well as income tax, which some cities also charge. And many of those are highly cyclical and linked to broader macroeconomic conditions. It is often difficult for cities to balance their budgets and fund their capital expenditures even in the best of times. Hence this need for federal and state aid. Entities like the C40 Climate Leadership Group has for years been helping cities try to find ways to finance their climate agendas, particularly where raising large sums of money for capital expenditures for things like infrastructure is necessary. Also worth noting here is the interplay between local and national governments and how revenue is derived and shared, and governance arrangements also often play a large role in terms of whether cities retain the revenue that they raise locally, or whether that is channeled back to a higher jurisdiction at a state or provincial level, or a national level, and then channeled back to them. As I mentioned, this picture can look very different in countries across the world, and it tends to be the case that cities in wealthier OECD countries have more autonomy and are more able to raise their own revenue as a general rule than cities in developing countries, which tend to have weaker tax collection and tend to rely more heavily on national governments. So some key points here, in terms of setting the context for the COVID-19 situation. Institutional and fiscal strengthening and revenue, so that revenue generation, so that revenue flows are predictable, is something that cities and as well as national governments have a general need for. Legislation is important, and providing clarity on fiscal management so that cities are able to issue municipal debt and raise capital from public markets is also very important. Something that is very well developed here in the US, but even in other developed countries and advanced markets, often there's not a lot of debt issued at the municipal level, and that is often almost completely absent in cities in emerging markets in the developing world. And another important piece is technical capacity to raise and manage revenue. Simply having strong fiscal management, having tax collection capabilities, and investment planning and project preparation are all really important. And I'll be coming back to those themes in this presentation. So talking about the COVID recovery, there's a massive need in general for infrastructure investment globally at the scale of $3 to $9 trillion a year. And currently, the bulk of that investment is actually being made in countries that are just now industrializing and creating their infrastructure base, so primarily low and lower middle income countries across the world. This is simply to meet the demands of economic growth and human development. There's a particular need to focus these resources on green and climate-friendly solutions. 2019 report by Morgan Stanley estimates that $50 trillion in investment is needed over the next 30 years to 2050 in renewable energy, biofuels, hydrogen, carbon capture, and electric vehicles, which even that list is only a subset of the climate-friendly technologies that need to grow to meet the climate challenge. Another area, for example, almost $1 billion a year is estimated over the next 10 years to be needed to reduce the rate of biodiversity loss and restore natural capital for ecosystem services. So there are many dimensions of investment that are necessary for a green economy in cities and beyond. So how does COVID recovery and COVID stimulus come into the picture? Now, I should say that these data are a little bit dated now. They track back to last September, but with the exception of the recent COVID recovery and stimulus package passed here in the US, I don't think there have been a large number of government-funded stimulus packages in recent months. And so these estimates, which we helped to develop at CFA, I think still hold, of 12 to 15 trillion dollars, which is a sizable number. But what's somewhat disheartening is that only a small share of this, about $600 billion or 3 to 5%, is explicitly green. In other words, that in the national plans or in the enabling legislation, there was not necessarily earmarking or stipulation that these funds needed to be spent in a green way. And I think evidence that has accrued since many of these plans were first put out, dating back to last spring, suggests that indeed a lot of this investment is going to sort of incumbent, a brown and gray infrastructure. So that is an area where I think the effort to get the funds out the door quickly, in many cases, trumped the need to make sure that they were consistent with climate and other a circular economy and sustainability objectives. So that's I think kind of the glass half empty view. And in fact, a lot of those funds, about half of that 600 billion is from or more is from the EU alone. And so if you look at the stimulus from the rest of the world, it's actually an even smaller percentage. The good news, however, is that to stay on track for a 1.5 degree pathway over the next 4 years or so, only about 10% of that COVID stimulus actually needs to be invested in those climate solutions. And so 3 to 5%, while low, is not perhaps as low as it might seem when you consider all the various categories of investment that the stimulus goes to. At the right here, we've also listed a few different indicative policies that stimulus goes to, just to give a sense of how different countries have approached their green recovery stimulus agendas. For example, Brazil used its state development bank to provide financing for energy efficiency and new green bond issuance. Canada used gas tax funds for local infrastructure. China passed a tax exemption for alternative energy vehicles and created a new national green development fund. And France channeled some of its stimulus resources specifically to public cycling programs and to cycling maintenance and job creation. What else have we found are key underlying trends that may be driving investment, particularly private investment, towards green solutions during the green recovery? There are regulatory and market shifts that are key signals coming from policymakers and market supervisors. Entities like the Network of Central Banks and Supervisors for Greening the Financial System, Sustainable Banking Network. There's the Coalition of Finance Ministers for Climate Action, and also new standards and systems of categorizing and measuring green investments, such as the EU Sustainable Finance Taxonomy, that are making it easier to have harmonized approaches to identifying, classifying, and validating that financial flows are green and are pursuing green objectives. Are all becoming more widespread, which speaks to investor awareness, investor preferences. It speaks to government mandates, and it also simply enables the funds to move into the space, because famous management maxim from business is you can't manage what you can't measure, and historically it's been difficult to measure these green finance flows. Private finance is also innovating through various green finance instruments, such as sustainability-linked bonds, social impact bonds, digital finance and crowdfunding. These kinds of things are still a very small percentage of financing that is going to green sources or to cities in particular, but they have a lot of promise for the future. And other instruments include debt for climate swaps, nature performance bonds, sustainable infrastructure, and just transition bonds. And as I'll come back to a little later in this talk, there's also a lot of financing that's now being deployed by development finance institutions or DFIs, and particularly the multilateral development banks, the largest and most widespread of these DFIs, specifically for COVID. And in some cases, that funding has also been earmarked for climate or for green, though it's not necessarily all directed specifically to this area. So let me run through a little bit of this background of the paper. We did this for the C40 Cities Climate Leadership Group, which is a network of megacities. They coordinate on climate action and policy. And their premise in coordinating action in the time of the pandemic is that cities are critical to delivering a green and just recovery to the pandemic. And they, in April of last year, C40 convened a group of mayors called the Mayoral Task Force, the COVID-19 Recovery, or MTF. And the MTF has been spearheading research and action on approaches to the green recovery to create jobs for city revitalization while also addressing climate objectives. So the assignment that we at Climate Finance Advisors were given was actually to help identify financing approaches and opportunities that cities could pursue in pursuit of 8 action areas that were identified by the Mayoral Task Force as their priorities. And so these sort of triangulate amongst economic revitalization, social justice and the just transition, and climate objectives. And these are about livability, they're about jobs, they're about sustainable development, all in a city's context. So I'm going to walk through a lot of detail here, I think, pretty quickly. I'm happy to return to this further if the discussion takes us there. This was a fairly intricate assignment that had a number of different nested components. One was identifying specific policies that cities could pursue that would align to those 8 action areas that I showed on the previous slide. Another was a review of policies that have been taken not only to address those areas, but also to promote green finance and the green recovery at the city level and respond to the pandemic. We reviewed the stimulus packages that we could find from national governments, supranational governments like the EU, and also from development finance institutions. And we also looked at market trends, which I spoke to a little bit already, and tried to wrap in all this together. How did we go about this? First, we came up with a long list of regulatory policies, programs, and investment actions and outcomes that we could identify that were relevant to the action areas. We identified and assessed a number of finance options that are open to cities, which I'll talk more about in a moment. And then we pared these down to a short list that we thought were most promising to cities, and then focused our attention in the paper on explaining what these are and how cities might go about procuring financing to pursue these different policies under the 8 action areas. So here again is sort of a schematic of how we did that. We started with the policy options. We developed a finance taxonomy of different ways that that cities can raise capital, and then we came up with a decision support matrix that sort of overlaid the policy on the finance, and then took other considerations such as the accessibility and viability of financing options, how climate friendly these were, how appropriate they were for the pandemic setting, and then distilled this down to a set of policy preferences. I cognizant of the time, so while this slide, I think, encapsulates what might have been my favorite part of the assignment, which was trying to come up with a taxonomy, or sort of a way to slice and dice different sources of revenue that cities get from different sources, and then use that for our analysis. It's one could spend a lot of time on this, so I will simply mention that it has a few different stages and a few different types. Fundamentally, we broke city financing sources into on-budget, as in those that directly go into city coffers, versus off-budget, which is raised through financing mechanisms that don't necessarily go through the city government institutions themselves. We looked at different financing mechanisms, which are a range of different financial instruments. And we also looked at sources of financing, which could be taxes, it could be local revenue sources, it could be state and national, as we showed at the beginning, and it could be also funding from the private market or from development finance institutions. We looked at a wide range of factors in our decision support matrix, including co-benefits of different policies, which financing mechanisms were really within reach for cities, whether co-financing was viable, how states could raise revenue through the budgeting process, and also risks and barriers. And some of the key takeaways were that financing is indeed available for cities to pursue a green and just recovery, even though it might not seem that way, despite a lot of the strictures and loss of revenue and increased strain on budgets that cities are facing, and that cities have an opportunity to leverage part of stimulus packages, as well as these regulatory market shifts that we were describing, that are shifting towards a focus on climate friendly and environmentally sustainable and just socially just investment, and that by leveraging those sources and market trends, they may be able to raise capital for these policy agendas and investment priorities. That said, all of the challenges that cities face with developing projects, with capacity building, with raising revenue, with managing these projects and designing infrastructure in a sustainable way, all those, of course, remain as they existed prior to the pandemic. There is a need for governments and development institutions to assist cities in tackling these challenges, which is a real area for the development community and for national governments to provide targeted support to cities, both financing and technical assistance and capacity building, and administrative support and project preparation, which may be seen as sort of less sexy aspects of raising financing, are really critical building blocks to allow cities to tap into these funding sources. And cities also have an opportunity to send policy signals with at the level of the city jurisdictions, and to engage stakeholders and build technical and administrative capacity for revenue generation and fiscal management. So that's the first paper. Now let me pivot quickly to the second paper from CCFLA that looks on urban climate finance, particularly from MDBs, I'm going to run through this pretty quickly. This is also, I should emphasize again, not my research, but we collaborated with CCFLA in the context of this work for C40 on the mayoral task force. CCFLA identified $20 trillion committed for COVID-19. These numbers are actually a bit more updated than from the previous study. These come from December. Most of the funding, they also, though, I think cast a slightly wider net. They found that most funding is for short-term liquidity to support local governments. This is particularly from development finance institutions. So these are sort of stabilizing loan funds and liquidity transfers, also from national governments to replace lost revenue. And that while development finance institutions are focusing more on cities, they still represent only a small fraction of overall funding, about 22%. Of this 20 trillion, they found that there were sort of these either very short-term assistance focused on humanitarian and health assistance, and then a very long-term sort of infrastructure planning towards building retrofits, green transportation, and green and spaces, recreation and commuting, and water and sanitation. And that there were, and you can also see on the right side of the slide the breakdown of financing amongst the different sources, whether national development finance institutions, private or city level generated. So in terms of what's been committed to the city level, there have been many piecemeal efforts from individual development finance institutions, but no concentrated or unified global effort. And there are a large number of disparate instruments that have been created that cities can potentially tap into. There is a disproportionate share for Europe and Central Asia. A lot of that is specifically for Europe and tied either to the EU or to Europe-specific development banks, like the European Investment Bank or EBRD, the European Bank for Reconstruction and Development. And that's noted here on the slide, that the EU members are largely supporting their own economies. That's the single largest source. Challenges and recommendations coming out of this study. Cities are often limited in their ability to borrow or access funding, and as a result, often have limited control and direct access to resources that they need. And so this actually dovetails with the findings from our study that not only do cities need to develop their own fiscal management, but they also need sustained support for local government, fiscal support, so that they're able to maintain credit ratings and borrow. That's mainly for cities that already have borrowing capacity in wealthier countries. And that funds should be increasingly earmarked for urban climate finance to facilitate a green recovery, something that, as we saw earlier, has not been happening to the degree that it could. And that more development finance institutions could develop instruments specifically for cities or that are open to cities, or enable them to access capital through sovereign loans that are issued at the national level, which is how multilateral development banks typically lend to countries, is through sovereign lending. A challenge is that there's large diversity in size, investor readiness, and scope of need from city to city, which can make it difficult to come up with one-size-fits-all solutions. And there's some recommendations they developed in terms of project preparation facilities, which we noted also were important to help cities prepare projects that are bankable and ready for financing, work with national development banks, aggregate projects and investments to make them more accessible to larger funders and financiers, and work with various networks and international organizations to provide comprehensive assistance. So this last section of the talk is the third study. This was actually a second assignment that CFA prepared for C40 over the winter and completed in January. This is unpublished research. Unfortunately, we don't have a corresponding study that I can direct you to here, but this study looked in particular at some of the programs of multilateral development banks that are accessible to cities and are promoting the green recovery. So there's a bit more detail I can share here before wrapping up and opening to questions. So in terms of some of our key findings, multilateral development banks, or MDBs, have set up a range of new funding facilities to support the COVID recovery in developing countries. As I just mentioned, MDBs rely heavily on sovereign guarantees, and so that means either loans at the country level or that are backed by the national governments, and so that often limits the amount and the type of lending that these institutions can make to cities. It's sort of capped at the amount of borrowing that national governments are willing to provide guarantees for. A couple other important points. Cities are increasingly seen as an important focal point for financing operations, particularly in the post-COVID environment, and that there are a handful of funds, including the Cities Resilience Program, CRP, the Global Infrastructure Facility, sort of a project preparation facility housed at the World Bank Group, and the IFC, the International Finance Corporation, have signaled openness to engage more in cities. We also noted that COVID-19 funding and MDB programs can indirectly benefit cities, even if cities are not themselves the beneficiaries, because a lot of infrastructure funding takes place effectively at the local and city level, even if it isn't directly going to cities. We also noted that C40 has an opportunity to support cities, just as CCFLA does, in providing comprehensive support and technical assistance, access to networks, et cetera, to help engage in planning, capacity building, and aligning sustainable development goals with these recovery plans. I'm going to run through these, I think, pretty quickly to make sure that we leave ample time for questions. But I will note that in recent years, development finance institutions and MDBs have recently been aligning themselves much more closely with the objectives of the Paris Climate Agreement and Sustainable Development Goals. So already these institutions are in the forefront in making sure all of their lending portfolio is aligned with these sustainability and climate-friendly objectives, and that has often put them in a better position than some other sources of financing to assist cities with their green recovery. I think I'm going to skip over this one. I've also already spoken to most of this. The one thing I will emphasize here is something I probably should have said a little bit more of at the beginning. The financial challenges for cities have increased. This impacts cities' ability to seek financing. On the plus side, low interest rate environment has increased investor interest in positive return opportunities, but that most of those investors still are looking for projects with a particular risk profile that's quite low, and that cities that are seeking to tap capital markets often do not fit with that profile, particularly in developing countries. They're either not creditworthy at all, or they're not able to access capital markets at interest rate levels that they find attractive. And so the donor funds, whether they're de-risking investment from other private sector sources, or whether they're providing the only capital that's available, these development institutions play a critical role for governments in general and subnational city governments in particular. And capital intensive investments in things like infrastructure and much of what's needed for addressing the climate challenge often fall in this category. Just to point out that in this study, we interviewed representatives from many different development finance institutions and MDBs, and closely examined many of their responses and specific facilities that have been set up either for climate, for the green recovery, to the pandemic, or both. And I think, yeah, I'll skip here to the key findings. MDBs, regional development banks, and development finance institutions have moved quickly to adapt their policies and adopt instruments that did not previously fit within their existing policy and operational frameworks to respond to the pandemic. Particularly, they focused on health measures, social safety net, and economic resilience. And as I mentioned, they have oriented their portfolios more broadly towards green infrastructure and towards climate-friendly investment. There is some fast tracking that's going on to enable cities and other borrowers, public borrowers, to access financing more rapidly. And there are a particular set of programs, some of them listed here, like Asian Development Bank's Living Cities Initiative, African Development Bank's Urban and Municipal Development Fund, EBRD's Green Cities, World Bank's City Resilience Program, that are specifically targeted to cities and can help access funds quickly. At the same time, most of the old rules still apply for project pipeline, project design and development. There is still a lot of interfacing that needs to happen between cities, national governments, and these DFIs to really make sure that their objectives are aligned and that they're developing robust projects that are financeable. This question of governance at the city level and strong financial management are key. So maybe I will stop there and open things up for questions. And thank you for your attention.
Well, thanks a lot, Andrew, for the really informative presentation. So we have received a question from Lily. Lily, would you like to unmute and ask the question? Or I can also read it out for you alternatively.
Sure.
Yeah.
Hi, really great presentation, and I'm glad the effort is going on. Let me also share video. Can you see me? Okay. Yeah. So you talked a lot about the sources of funding and financing. Part of that is from the private sector. We know that a lot of banks and you know, the large banks all come up with different climate or eco-friendly investment funds or tools. How would you suggest people go about selecting one that's credible and it's actually directing into companies or projects that is real? I mean, real meaning it really, really green and just.
Thanks for the question. Just to make sure I've understood you correctly, do you mean how should individuals select a bank to bank with and assess, you know, their sort of bona fides as a
select funds? That there are many funds out there that claim to be eco-friendly, social responsible, and so on. As a private investor, it's very difficult to sort one out of the other. They all have the same buzzwords.
That's a terrific question. I think there are a lot of efforts afoot these days, some of which that we at Climate Finance Advisors are involved in, to improve sustainability metrics, sustainability reporting, to be able to really separate the signal from the noise, right? And to be able to really distinguish substance from greenwashing, right? And I think you've hit on a real problem. And even the leaders in financial markets and investing, in banking, in watchdogs, and in the environmental community, I think sometimes struggle to distinguish between these different investment opportunities and to assess their performance. What I can say is there are some reputable ratings platforms out there, and that there are also ESG rating services. I guess it depends on what specifically you're looking at, whether you're looking at publicly listed corporations to buy stock in, or whether you're talking about the performance of individual financial institutions, or whether you're talking about investment funds. I think for publicly listed securities, that space has developed more quickly, I think, than it has perhaps for funds. Funds often do their own ESG and sustainability reporting, but it's often self-reported. And so if they're not mandated to report against any particular frameworks, that can be spun any number of different ways. Yeah, really, really good question. But I don't want to get too sidetracked with that, because I know there are others that are tied to the presentation. So a terrific question. I wish I could take more time to address it, but I'm afraid of using up all our time on that one. So maybe I'll allow some others to weigh in.
Yeah. Thanks for the response, Andrew. Another question over here and is about conditionality. So in your presentation, you mentioned an estimate that less than 7% of global stimulus, they're actually related to green spending. So my question is conditions, right? What about conditions that are attached or could be attached to the rest of the 93% of the stimulus? I think we have seen, a lot of examples like keeping staff employed, and in the EU, no bailouts for firms, linked to tax havens, no share buybacks, so on and so forth. What about green conditionality, which I personally believe is very important if you want to promote green recovery? And in the report, you mentioned a couple of examples. For instance, the Canadian government requires the beneficiary companies to actually adopt climate-related financial disclosure. And you also mentioned a little bit about green targeting by central banks. So could you share with us a little bit more about these policy tools?
For sure. It's interesting. Central banks and financial ministries until very recently didn't really see it as their business to promote what we're seeing as social or environmental objectives. And so, efforts were, I think, generally not seen as the purview of central banks to do that kind of thing. There, fiscal stimulus, our budgetary funds that were allocated. There was this idea of green stimulus really was pioneered to a large degree during the financial crisis of 2008 and 2009, and a number of countries, including China and the US, as well as others around the world, really made very large fiscal commitments. And so those can simply be written into legislation, right? And they can be earmarked, or they can be budgeted in a particular way that targets environmental or climate objectives or sustainability objectives. I think it's a little more tricky when you talk about financial regulation. There's a really interesting set of debates and discussions around this right now. Christine Lagarde, who's the former head of the IMF, currently the head of the European Central Bank, is very bullish on pursuing climate objectives through financial oversight tools and creating the kinds of conditionality that you were talking about. For example, only allowing, public stimulus, right, or purchase of corporate securities and things like that to be limited to green sources, right, or excluding polluting industries, and or helping to use fiscal tools to promote climate goals like reducing transition risk, which is risk of obsolescence or financial losses related to emissions-intensive business models. And so she's been very much in the forefront pushing those kinds of tools, and they can be quite sophisticated and be embedded very deep into financial oversight and regulation. Not everyone agrees that that's a good idea and that that's within the mandate of those institutions, and that maybe they're trying to do too many things at once. But there's no question that there is a large toolkit for pursuing those objectives. For stimulus dollars out the door, sometimes, as I was saying, it's very simple, right? It's simply saying, we're, as a national legislature, we're the holders of the purse strings, and this is what we're going to spend the funds on, right? And that's how we're going to push the funds out the door. Or, funds that will be allocated later can absolutely have those conditions put on them. And that is, I think, a very straightforward way to do this.
Thanks, Andrew. I think we have some time to perhaps take one or two questions. And Pallavi raised a question that could you perhaps talk about some examples of cities that have incorporated sustainability into their financial planning in a sustainable way?
So when you say sustainability, do you mean environmental sustainability, or you mean financial sustainability?
Andrew, I guess both. I'm kind of just thinking about what happens here in New Jersey, for example, with our 569 municipalities that are often competing against each other and trying to chase revenue sources, trying to chase projects that can bring jobs to their municipality and things like that. I'm just wondering if there are some examples of cities that have been able to somehow find a way around that dynamic and really incorporate sustainability into their planning frameworks.
Yeah, great question. I mean, there are a lot of ways to kind of try to answer that, but let me come up with a couple of specific types of actions that cities can take, and maybe that will be a helpful response here. So an incredibly powerful mechanism that cities have to promote sustainable investment is their procurement policies, particularly for large cities that actually have, tens, hundreds of millions, or even billions of dollars of procurement investment that they're making. And I mean, these procurement specs are often, most powerful with national governments, right? That have very large budgets, but even cities can help to establish these procurement mandates that embed sustainable business models into how they do business. I'm perhaps most familiar with New York City, where I live, and which is in the forefront on a number of policies. They have a large procurement division in the city that does a lot of work specifically around sustainable procurement. I think, setting regulations is also really important around, for example, building efficiency, around, diversion of organic waste out of landfills, recycling, things like that, that actually are decisions that can be managed at the city level or the local level. Building codes are often managed locally, and that's particularly important when you also consider climate resilience, and which is a critical issue pretty much everywhere now. One might focus on coastal areas in particular, but everywhere, having buildings that are resilient to storm surge, sea level rise, high winds, extreme temperatures, all those things, absolutely critical. Fire resistant, I mean, just looking at the major climate-related natural disasters of the past, year in the U.S., I think paints a pretty vivid picture. Looking at Texas, right, and the fact that there were not a lot of robust building insulation programs in Texas, and that was part of the problem that left individuals exposed and led to very high electricity use when temperatures plunged just last month. Vulnerability to wildfires. We saw in the American West areas even in the center of cities burning that no one even thought could possibly be exposed to fires in the past. And those are things that building codes can't necessarily solve on their own, but can be important tools. And one more thing I'll mention that large cities have used is congestion pricing, or even local carbon pricing, that can help nudge consumers and nudge local behaviors in directions that are more sustainable, and also develop or bring in revenue in the process.
We're almost out of time, but Andrew, perhaps could you also address the last two questions that we have briefly? So we have a question from participant Alden about sustainability linked bonds. How do sustainability linked bonds differ from green and social bonds? And Lily also came back with another question. How do government overcome the need to provide short-term returns, which the public expects, especially in the post-COVID period?
So sustainability linked bonds, there are a whole category of non-financial performance based financial instruments, some of which are more appropriately described as bonds than others, because some of them may adjust their payout, the coupon that's paid, or even the principal that's paid based upon some aspect of environmental or social performance. And there are some examples of that are a water and sewage management bond that was a performance-based issued by the city of Washington, D.C. But there are also other green bonds, and the term green bond or social bond can often refer only to the use of proceeds, right? And then to reporting on the use of proceeds to demonstrate that they're being used in a manner that's promoting the sort of nameplate purpose of that financing instrument. And so those are actually two very different things, but they're often sort of lumped in together or conflated. I think, the largest market and the one that, is most commonly encountered is sort of the earmarked use of proceeds. It's sort of a standard public bond, but one where it's being used towards the funds, the proceeds are being used for a particular objective, and then they need to be tracked and reported on, both the use of funds and the impacts of those funds in a more robust way than you would for your average municipal bond. But then there's this whole other category, right, where the actual financial returns that are built into the structure may be tied to the performance that is achieved with the use of those funds.
Yeah, Andrew, one more question on I guess the trade-off between long-term and short-term. So most sustainable policy would require big infrastructure investment that require a long-term perspective. But oftentimes we see the government could be prompted to focus on the short-term. So how do we put in structures to overcome the need to focus on short-term and make the government more long-term thinking?
You mean government investment, or you mean how the government can direct private investment to be less short-term focused? How the government itself is short-term focused, you mean?
Yeah.
How the government can direct, towards more long-term.
Yeah, that's a great question. I mean, it's tough, right? Because at least in democracies, right, voters vote today, not tomorrow, and so I think that's an eternal challenge. I think appreciating that decisions taken today will impact taxpayers and voters directly, right? Sometimes not always in the long term, but even in the relatively shorter or middle term, is critical, right? And I mentioned briefly one of the recommendations of our first study is stakeholder engagement, and so I think leaders at the city level don't just have to follow what their constituents are telling them. They can, be at the forefront and really engage different stakeholder groups and explain why these longer-term sustainability considerations should be weighed seriously against short-term considerations. And there are also tools, I didn't get into this as much, but things like cost-benefit analysis, long-term sustainability planning, under which budgeting and project preparation is housed. Measuring these things, establishing them as formal goals, and being able to capture these non-financial and longer-term benefits, as part of the planning process, are really critical to be able to justify and to tell the story of why these investments are being made. So I would note those few as really just elementary data collection, analysis, and storytelling, right? Which sounds straightforward, but is often very difficult, right? Because sustainability outcomes are often out in the future, and they can be difficult to quantify. But doing that is, I think, very important to make a compelling case for investing.
Yeah, I'm sure some of the audience could still have some remaining questions. So if you do, I strongly encourage everyone to check out the publications by Andrew and his colleagues on the Climate Finance Advisors website for more information. Once again, thank you to everyone for joining us today. We hope you had a fruitful session and have a good day.